Hello, my name's Wilkes. I'm a corporate finance manager here at Smailes Goldie Group, and I'm also a member of the Blueprint team, whose other members include Ian Stocks, Luke Taylor, and Pete Deering. Earlier this month, we gave a webinar on the topic of pivoting your business and building future resilience, which had a particular skew towards the impacts of the COVID-19 lockdown and how that's impacting businesses. Within that presentation, I gave a discussion with regards to the importance of cash and building resilience for the future. And today I'm going to go over that again, just expanding out and fleshing out on more of the points there that I raised during that presentation. So the first thing with regards to cash flow is understanding cash flow, and particularly what I mean by cash resilience. So when I'm talking about cash resilience, what I mean there is building the appropriate buffers in both the reserves of cash and the process of the business such that it has sufficient reserves to meet the demands and issues faced during any kind of issue, whether it be a lockdown or a recession or other kind of shock to the business itself, and making sure that the business is able to continue trading and able to meet its own liabilities as and when they fall due. And the next point there is why profit doesn't equal cash. This is one of the things that a lot of our clients get a misunderstanding about when they come see us. They're often coming to us with great profit and loss accounts. They might be making good returns at the bottom line, but they're not seeing that translated into the amount of cash they're generating in the balance sheet. And the main reason for that is obviously the other factors that are happening in the balance sheet. So that could be matters in terms of working capital movements, that's your debtors, trade creditors, and stock movements, as well as any capital expenditure, any tax payments, any debt repayments, and any drawings from the business on a personal level. If they're not all considered along with the profit and loss account, the profit and loss won't give a true opinion, and that's what a proper cash flow will encapsulate. So what are the problems we've all been seeing during lockdown? Well, the first one obviously is it's been one of the biggest cooling offs of the British economy for generations. That's immediately going to impact performance and trade, which reduces profits, and obviously profits ultimately turn into cash and thereby reduce the ability to generate cash. So that ties into my next point around the issues with fixed costs. Most businesses have been able to quickly cut their cloth in terms of variable costs. And by variable costs, I mean, for example, if you're a producer, a manufacturer, we're talking raw material costs, those things that can be quickly stopped if activity levels fall back. However, Luke in his presentation talked about hibernating businesses, and when a business hibernates, there are elements of cost that it cannot avoid, and these are the long-term contractual obligations of the business. So, for example, I'm talking rental agreements, any long-term leases for equipment, any debt repayments, as well as employment costs for the core members of staff. Now, a lot of the government assistance that we've seen recently has been put in place to deal with most of these issues in terms of the cost that businesses will face irrespective of their level of trade. The next point there is around working capital, and I'm sure that many of you running businesses will have seen your customers come to you perhaps ask for more time to pay, and conversely you'll have had suppliers come to you saying, can you pay us sooner? Now obviously both of those counterparties are trying to manage their own cash flow and improve their own cash position. With it being a zero-sum game, however, if you were to concede on these matters, the impact would obviously be a converse reduction in cash for yourself. And the other part to working capital there is obviously stock. Now, stock may have been at an appropriate level pre-COVID-19 lockdown. However, you are now in a position where due to reduced activity levels, that might not be the right amount of stock to have on hand, or it might include line items of stock that you could easily pass on before that, but thanks to COVID-19, they're not appropriate levels of items to sell thanks to changes in consumer demand as a result of the lockdown. All of that's going to tie up cash on your balance sheet, which is going to take longer to convert to cash and therefore impact your cash if it's not behaving as it was beforehand. And the final last point to consider is debt impacts. A lot of businesses will have had debt on their balance sheet that they were paying off at a time when their trade was at a level which is much higher than it is at the minute as a result of lockdown, and therefore they're seeing that sort of eat into their cash. They might have to discuss, and obviously I'm ignoring CBILS and bounce back here, but they may have to approach their bank to discuss how they can continue with this, whether they can look for a holiday or any type of arrangement with the bank. And one point I just want to make about debt, just to consider there, is if you have invoice discounting, and I'm just flagging invoice discounting because unlike most of the loan forms where you are repaying a fixed amount of capital and or interest. Invoice discounting obviously works by the fact that you're borrowing against a debtor book. Now, a debtor book changes in value subject to the amount of trade you're doing. So it's great when a business is growing, it's great because you're making sales, which is improving that debtor book. You're able to release that cash sooner by borrowing from the bank. Conversely, the opposite is true when the business is deteriorating, as may have been seen during lockdown, where you'll see that asset, the debtor book that you're borrowing against, will be deteriorating value, and banks apply a cap limit on the amount they'll lend to you, usually as a percentage there, around 85% generally, and they will be clawing back that as the debtor balance reduces. So at precisely the time where you might need more cash when things are dipping, the bank will be clawing back more of that loan. So it's just to bear in mind the impacts of invoice discounting going forward, and make sure you fully understand that trade's impact on the cash flow going forward, especially in a detrimental situation. So what are the solutions? Well, I won't dwell too long on this one, as it in itself could make a full presentation. But many of these schemes have been out since the lockdown broke out in late March. And so obviously the first things just to bear in mind is, are you using all of these tools and assistance that are available from the government to make sure you're building that buffer in the business? It's no good sort of sitting there thinking, well, I'll wait till I need it. I think quite often it might be easy to take full advantage of these, and then if you don't, to then repay later. And just to sort of flag at this point is that obviously these are constantly changing. We have a great website where you can review all of these. We have, which are regularly updated as well. We've got some great FAQ sections, as well as the schemes are changing, we're making sure that's reflected there. Obviously, ones to flag to you here right now are that the VAT deferral has ended. So if you have built up any sort of outstanding balance to HMRC, that'll be due by the end of March 2021. Make sure you've reflected that in any cash flow going forward. Similarly, restarting the direct debits if you pause those. And the other point to raise is that furlough is coming to an end. So if you do have employees still on furlough, just bear in mind that that's going to start tapering off in terms of the amount that government are going to contribute, and you yourself will have to make up the difference to 80% until it all ends in October 2020. So the next point is in terms of internal review. So what can we do to help the business in terms of the processes that we have in place at the moment? The first part is turnover, and there's two elements I'd like to talk about turnover. The first one is around concentration. So when I've got my corporate finance hat out on and I'm in the market looking at businesses for sale, I will obviously attribute more value to a business that has a more diversified turnover base. And what I mean by that is two businesses with the same level of turnover, if one has 4 customers to whom it makes that revenue and another has 100, I'll attribute more value to the business with 100 customers, purely on the basis that if everything else is the same profit levels and whatnot, because a more diversified portfolio of customers spreads the risk. And when these economic shocks hit the whole industry, everyone feels it differently, subject to their own management. And the risk is that if you lose 1 or 2 in a smaller concentration of customers, the impacts there will be far greater than if you had a more spread out customer base. So all I'm saying here is, are you reviewing your processes for sales to make sure that you're not just going down the same processes of approaching the same people to push more revenue through? Could you look at diversifying that and bringing more customers if possible? And the second part of turnover is overheating. Now, overheating is something that actually we talk a lot about with new startups or rapidly expanding businesses. And the risk there is, what happens is you have to lay out a lot of cash up front to grow a business before you get that backing from customers. So I'm talking, for example, buying more stock, increasing your creditors, and also taking on, for example, more staff. All of this is outlay that you have to make up front, that doesn't come till later down the road once the profit is secured and the customer is paid. Now, obviously, a lot of people have seen a decrease in sales as a result of lockdown, and the temptation would be to quickly ramp back up to normal levels, if not better. And just to bear in mind the issues of overheating, if you're not already doing a sort of fully integrated cash flow forecast, just to consider the impacts that you're going to have on the business by going through that rapid change. So next one's credit control, and by credit control I mean the process of invoicing customers on a timely basis and making sure those debts are chased and brought in appropriate terms, along with the credit control system in terms of credit limits. And all I'm saying is is that a well-oiled machine within your business? Are customers being chased timely? Are invoices raised as soon as the work is done, or on a stage basis if appropriate? Are you ringing up the customer regularly, say, well, have someone chasing that debt to make sure they don't go old? Again, if it takes time to repay, that's all going to affect your cash position. And similarly, credit limits. You may have credit limits that were appropriate pre-COVID-19. Go back at those, have a look at those, refresh them, and make sure that people aren't taking on work that are pushing the amount of debt on the ledger above those credit limits before we take on that work. Let's make sure that payments are received before we begin that work on the next stage of work, for example. If you've got that, great, review it, keep on top of it. If you don't, outsourcing is an option in that sphere. Next thing about supplier credit terms. This is something to bear in mind. A lot of when I'm out in the market doing a due diligence for a client and acquisition, if I see a business that has what I would consider excessive credit terms with its suppliers, I just sort of dig into that. And if I find that contractually they're obliged to say 45 days, but I've noticed they're taking 60 days to pay, you talk to the FD and he's on the opinion, we're friendly with these guys, they give us a bit more time than we're contractually obliged to, which is fine when all's well in the world. But when matters become sort of adverse to all businesses, you'll find that people saying, well, actually, you're contractually obliged to 45 days, I'm going to bring it back now. So it's just about saying, have you accidentally built any of that into business? If you are getting more supply terms from more days in term credit from your, is that contractual? Is that agreed? Is that written down? Or is that something that can be quickly taken away? Because if it can be quickly taken away, it's a big risk you've got in the business, and to make sure that not to leave that there, because it could be quite a hidden liability in the business. If they quickly pull that down, you'll have to go straight to your bank and you could find yourself with a big shortfall. Next is capital expenditure. And what I mean by capital expenditure is any kind of large items. If you're a manufacturer, we're talking sort of big factory improvements or project outlays, not just talking laptops, unless you're buying a lot of laptops, obviously. So what the problem with capital expenditure can be one of the biggest, chunkiest purchases of the business. So the big thing here at the moment is to make sure, is that capital expenditure needed at this time? If not, can it be delayed? Can we look at alternatives, for example, repair and maintenance of existing assets, or perhaps second-hand assets, short life, which might have a short life but have much more value for money at this time? Alternative is absolutely necessary. Have we looked at appropriate levels of finance? Asset-based lending is a big market at the minute. There's plenty of options out there, and they're all competing to give you a decent rate. So that might be worth looking at to make sure we can spread that cost going forward. And the next point there is pricing. So obviously, when it comes to pricing, the big temptation during a fall in activity and profits is to drum up more activity through a quick slash of pricing. Not to say that's not a good strategy. It can be an appropriate strategy, particularly if you find yourself everyone in the market's moving that way. However, just bear in mind when you're setting that pricing that you do it with a completely considered opinion of the profits of the business. That is to say, if you are taking this cut, can you pass any of it on to your suppliers? Are there any efficiency savings you're making in the business that can help maintain your margin levels? Because the risk is, if we take a big slash to the price without considering the impacts of the business, we may end up in a sort of break-even or loss-making position at that point. And what's more, if you can't pass that on to your suppliers or your customer, you'll be left stuck holding that margin decrease. Which, if you can't then pass that back onto your customers at a later date post lockdown, you may find yourself stuck at this position with a much less profitable business. And the next point here is about overheads. Pete gave a good presentation, which I recommend looking at his video about all of this around waste in the business, and that's something that here at Blueprint we can help you with. It's not just about cutting overheads, it's about making sure we remove the waste in overheads. And it's just about a case here of making sure that, have we considered all of that, and are we going to make sure that what we've learned in lockdown carries on going forward? Next point is around drawings. So a lot of SME businesses are obviously interested in making sure that funding quite often a lifestyle for the owner managers, and that's a sort of a sub-function of the main business function itself. And its temptation is there to make sure to draw as much cash as possible to maintain lifestyle as possible, but it might be worthwhile considering leaving a buffer in and building that in through reduced drawings over the next year or so to ensure that the business is able to build up more of a buffer itself. So just make sure that you're considering both parts of the formula as an owner managed business. And the final element I'd like to talk about here is CFADs, which is cash flow available for debt service. This is something I mentioned earlier in my presentation. And CFADs is a good multiple that a lot of businesses look at. And if you have debt already in your business, it's worth knowing your CFADs business, because I promise you it's the one that the banks are looking at. And CFADs is effectively a ratio of the amount of cash you have available for debt service, which is basically calculated as EBITDA less any capex, any drawings, and any tax payments that you're going to be making. So just think of it as, after I've done trading and I've bought everything I need for the business and taken what I need from the business, what's left? And that, as a ratio of the amount of debt you have to make in a year, will give you a rate. Now, minimum ratio is obviously 1-for-1 to make sure that the surplus cash I'm generating at least covers the amount of debt I have to repay. However, banks typically tend to set limits around about 1.25 for that ratio. That's to say, at least you are generating 25% more cash than you need to service this debt. And that's the buffer they like to build in. So perhaps review this, particularly with the changes your business are facing, and make sure that you're achieving that level of a ratio to help give you some guidance to make sure that you have an appropriate buffer in the business. So this brings me on nicely to my final section, which is regards to forecasting. Obviously, as a corporate finance manager, forecasting is something we regularly do for clients, and a lot of people only think about forecasting at key moments in the business life. So we're talking moments like making an acquisition, a big capital project, or perhaps a detrimental turn down in business, and the bank has asked for a forecast to understand what's going on. Now, I actually think forecasting is something that business should be doing all the time. And the main reason for that is for me, financial statements are great, but they're retrospective. And to be looking forward, if we're driving a car, we're looking where we're going, not where we've been. And just to have a model that's available to you to say, right, this is where we are now, being your balance sheet opening position, and this is where we're going to go. How is that going to affect my business? Now, obviously, the biggest thing that kicks out of that is, how is that going to affect my cash? Because if you don't have the cash to do what you want to do, then that's going to stop anything you might do, particularly if you're facing a lot of strategic decisions at the moment. It's worthwhile knowing in your head as well, when you go into negotiations with customers and suppliers, what is your limit? What can I take and to make the business get to the position I want it to be in? If for example my suppliers say no, 30 days is payment, but I know I need 45, it's worthwhile knowing that because of a forecast if it's objectively measured. So when I'm talking about an integrated forecast, what I'm talking about is make sure that that forecast has a profit and loss, a cash flow, and a balance sheet, and all three of those are talking to each other and not done individually. Because the risk is, if you just do a profit and loss forecast or a cash flow forecast on its own, what you'll miss out is the other impacts that I mentioned right at the beginning of this conversation with regards to the impacts of working capital movements or any debt repayments. And if not all viewed together, then you'll miss those, and having them integrated together allows you to see if some of those assumptions are off. And in terms of frequency, I think it's appropriate to do a sort of 12 to 24 month forecast. Just on a monthly basis. It's a temptation to go for a weekly or daily forecast, but however, we only tend to see that in cases where businesses are struggling. And in those circumstances, there's a sort of catch-22 there, that you need a lot of resource to do that, but you might not have the resource to do it at the time. So we typically only see that happen where banks are sort of parachuting in some sort of help to get a client through that process. But I think for a normal trading business, a monthly 12 to 24 month forecast will be appropriate. And I think you should review that. Obviously, I would set it up at every year end would be a good time to do it. Maybe review it every sort of quarter or 6 months, update it as necessary, and just make it nice and flexible. And by flexibility, I mean use either some sort of software to help you do it. If it's just a standalone entity, there are software available that we can help point you towards. Or equally, an Excel-based forecast can work just as well, just as long as you're careful with your inputs and make sure you fully understand the formulas that are going there. But my Excel has been the basis of a lot of forecasts for a long time. And just to make sure that you've got something that's nice and flexible there, so that as you can quickly put in changes to, for example, seasonality, any turnover levels, your gross profit margins, big overhead movements, and big capital expenditure in the business, and variances on working capital. So we're talking debtor days, creditor days, and stock days. If you've got a model that can adjust those fundamental points, I think it'll serve you very well and just help you understand, if this happens and everything else stays the same, how's that going to affect my cash and how will I be able to work through that? And it'll really help you to underpin some of the strategic decisions and help drive the business to what you would like it to be, which in Blueprint we call our now, where, how analysis. And to integrate your now, where, how strategies with a forecast can be very powerful. And that's certainly something we'd be happy to help people out with if they're interested. So that's it for me. I hope you found that useful. Like I say, if any of the questions that come out of this or this provokes any thoughts, by all means contact any member of the Blueprint team at the beginning, and we'll be happy to discuss it. Thank you very much. Bye.